Hi, Gary here again. I'm I'm continuing my conversation about amateur investing, or more like gambling, but in the stock market as opposed to scratchers or the Powerball. Um, this series is basically trying to get you involved with a an investment practice that has a higher possibility of you not losing as much money and maybe even possibly uh, gaining some money, you know, uh, as opposed to investing that money into something that has a lower possibility of getting any money. Um, so the last episode that I had talked about, the last video that I had talked about was what was a company, what was the purpose of a company, and in particular, why would a company sell shares of stocks to people, and why would people want to buy those shares of stocks? So, in summary, a company is an entity that is trying to make money, in for the person that started the company or the people that are in the company or work for the company, and they sell shares of stocks in order to help that company raise revenue for growth or production. Um, and the people buy stocks because they want to invest in that company because they believe that company will grow, and in so doing, the growth in the company would return on their investment. Um, they call that ROI, return on investment. There are also people who invest against a company because they expect that the company would be going downhill and they can make a profit off of a company doing bad also. And just like you would in gambling, you can bet against or you can bet for people or things or events, and you can stand to make some money. So it's all about odds and likelihood and stuff like that. Um, so that was what the first episode was about, just kind of explaining that. In this episode, I want to try and touch on some indicators or some things that you can look at that would help you determine on whether you would want to put money into a company or not. I'm going to be primarily focusing on looking at and determining if a company is going to be getting better. I'm not going to talk much in this episode about how you can capitalize on a company doing worse. We can always take that for another video. So, as an amateur investor, you have to realize that your investments might not, probably won't get you rich. Okay, um, and knowing that you don't want to risk your the money that you have for your budget, like your mortgage and utility bills and stuff like that. The money that you're going to put into this is probably needs to be considered disposable. It's gambling money. Okay, so if you're going to put that money into a scratcher's ticket or the lotto, that's the money you want to use, rather than actually buying a scratcher's ticket. You just have a better chance of getting some money back. Okay, so that's my disclaimer. Um, so let's get right into it. What are some ways to determine whether you want to invest money into a particular company's stock? And um, how can you go about doing that? What kind of strategy can you take in investing that money? So I'm going to kind of talk about the one of the first things that, if you're really newbie at it, you're probably just going to go with companies that you feel good about, like something that you believe in. If I believe in a particular industry, I believe in the oil business, or maybe even I work in the oil business, and I'm an employee of Shell or Exxon or whatever, I want to support that sector. I want to support that, you know, that company. So I'm going to buy stocks in that because I believe in it. It's you have a little bit of insider knowledge on it, right? Some sort of domain knowledge because you work for that company, and you can kind of have an idea on whether it's going to do bad or not. And um, that it's almost an insider's perspective. So that's one indicator is an insider's perspective, and you can buy when you feel like it's going to be doing good because you're inside the company, knowing things. Now, keep in mind that you know there are rules on insider trading, obviously, and so you'll always want to be cautious about buying on some piece of information that that other people don't know. Um, but usually companies are pretty good about not disclaiming any kind of news about the direction of a company until the right time. So, as an amateur investor, you're 9 times out of 10, unless you're rich, you're probably not going to have to worry about that. And if you are rich, then you're probably going to have financial advisors doing your investing for you. You know, they're much better at it than you will be. And that's going to be my second disclaimer, is that if you really want to make good money in the stock market or investing, um, unless you are very experienced and have a lot of knowledge about finance, then you are going to be better off in letting a financial advisor take care of you. They know what they're doing, and they're going to give you the best return on your investment, bar none. You have to be careful about, be selective about your financial advisor, and determine what type of financial advisor you want to choose. And we can talk about that in another video, but um, just typically you're going to make more money if you have an advisor help you out. Okay. And I'm not talking about a broker. I'm not talking about opening up an account with Schwab and just putting money in there and expecting that it's going to grow. You literally would need a person or a manager that's giving you advice based on your personal financial situation. That's not what these video series are about. These video series are about investing on your own and hoping that you're going to make some money. It's piddling money. It's stuff to keep you. It's rather than playing a video game or investing in, uh, the lottery. It's stuff to play around with. Okay, you're a shade tree mechanic or a shade tree investor. You know, that's what this is. So anyway, one of the second things, indicators that you can go off of, is how are how do you feel about a technology or a product. Maybe you're not inside and knowing specifically about a particular company, but maybe you like something. I like technology. I like new technology. I like smartphones and smart glasses, and I like Tesla trucks or electric cars that float, or those are things that I think is cool and that I want to see for the future. So I would invest in that and hope that those things grow in my lifetime to see those come to fruition. Uh, those are things that I invest in and enjoy. So I'm gonna I'm gonna invest in them, and hopefully they will do good. Um, a lot of people in the nation, the United States, they'll vote for a politician based on a party that they like or something about that leader that they like. It's kind of the same thing, right? You don't know 100% if you're going to get something out of it, but there's something about them that you like. And this is kind of the same concept. And once you invest a little bit, and you should always start with just a little bit. You never dump everything in all at once, or it's going to become troublesome, and we can talk about more about that later. But just do a little bit at a time, and as you become more and more familiar with it, and after months and years, you've played around with it, you can kind of get a feeling on how much you want to put into a certain thing, and how much you want to keep aside. um, and we can talk about that later too. So another indicator that you would have would be um, pattern trading, or looking at a graph and determining, um, based on that graph, how you want to invest. So as you can see behind me, you can see a drawn graph, uh, and you can see it kind of, the black line you can see kind of going up and down and up and down and up and down. But you can see the blue line that draws kind of a line through that up and down graph, which is what you would call a trend line. And basically, you can see that even though that graph is kind of going up and down and up and down, it's trending upwards. And you're always going to have a trend in one way or another. It's possible to have a flat trend where it's going up and down and up and down and up and down, but the trend line is flat. So those are kind of your three types of trendings. You have your uptrend and your downtrend and your medium trend. What we're focusing on is the uptrend. An uptrend basically means that the company is going to be, it has shown a history of improvement, of growth. And as it goes up like that over 1 month or 3 months or 5 months or a year or 5 years or 10 years, you can kind of get an idea of the stability of that company, the growth of that company, and the confidence in how much you want to invest in it. So if you invest, for example, uh, at any point in time, let's just say that this is uh, a 5 year graph. That means you could have invested here, or here, or here, or here, or here, or here. At any point in time, you could have invested, and your confidence is high that it's going to continue to grow and get you some money over time. Okay. Um, if you shorten that to like a 3 month span, the graph might look the same, right? But if you take a look at 3 months versus a year, well, you might see that in 3 months it's increased uh, significantly, but over the year it's down for um, most of the year. So you would see in the last 3 months this trending upwards, but over the whole year it's trending downwards. So you have to look at both, um, or all of the different trend lines over different chunks of time: 1 year, 3 months, 1 month, 5 years, 10 years, and make a decision on, do you want to take some of your money and put it into it based on those trend lines. So let's say, for example, I'm looking at 1 month and I'm seeing it trending upwards over 1 month, but it's down for the whole year. My thought is, well, you know what? Maybe it'll recover. Maybe I can put some money into it since I'm seeing this 1 month trend line, and maybe it'll continue to trend upwards. And you can also think to yourself, well, you know what? It is down, and guess what? When it's down, that means it's on sale. Okay, and when it's on sale, what do you do when there's a sale? Now, you don't want to buy it when it's on clearance. That's a little different because in the stock market, when it's on clearance, it pretty much means it's going out of business and it's going to be worthless at some point. But if you feel the company's strong and it's on sale, then buy it. Okay, so um, that's another indicator is using these graphs. Another indicator, as you can see up here in the blue, it says EPS. That means earnings per interest, per share. Earnings per share. And basically, what that means is that a company makes money. Okay, it's called earnings. They are earning money, and they record all of the numbers that they earn. And basically, they have expenses. Okay, and they spend money, but after all the expenses, you have what you call a net earnings or a net income. And that also includes any dividends that they paid out. So if I made $1,000, but it costed me $300 in expenses and another $200 in dividends to run that company, then what's left over is $700. $700 is my net income that I made in that company. And um, if that's what you would call earnings, okay? And what they'll do is they'll divide that number by the number of outstanding shares, right? So if there's 1,000 shares and I made a net profit of 1,000, then my earnings per share would be one because 1,000 divided by 1,000 is one. What you're looking for as an indicator is a higher number. So let me just kind of demonstrate that. Let's just say I am making a net profit or a net income of $1,000, and my company has the number of outstanding shares is 5 shares. Okay, I always do like these low numbers just for the math, but usually in real companies you're going to have millions of shares, right? But the company's also going to be trading or making millions and millions and millions of dollars. So the math is always the same, regardless of whether it's $1,000 or $1,000,000, and then and 5 shares versus 5 million shares. The math is always the same. So I just keep the numbers low for example. So let's say $1,000 is what they made net. Okay. And let's just say that there's 5 shares. Okay. So I'm going to divide the $1,000 by the 5 shares. 5, 1,000 divided by 5 equals 200, right? So my EPS is 200, okay? 200 is worse than 500. 500 is better than 200, okay? Let's just reverse it a little bit, and let's say that there are 5,000 shares. We still have the same $1,000 net income, but let's do the math a little bit differently. So hang on just a second and let me erase this and show you the math the other way around. Oh, there we go. Man, let me get a little spray here. I'll spritz the spray. There we go. Erase that. All right. Okay. So let's change this to, instead of 5 shares, there are 5,000 outstanding shares. Let me get another spritz of spray. It's gonna bug me. There we go. All right. Okay. So let's say there's 5,000 shares. Okay, the math is the same. It's the earnings, 1,000, divided by 5,000. And what you're going to get is a fraction now, right? So we've got $1,000 of earnings divided by 5,000 shares is equal to 0.2. Okay, so now your EPS is less than 1. Something less than 1 basically means that it's there's how do I put it? The value of the shares is not very great. It's diluted. You know, there's too many shares and just not enough profit for each of those shares, and um, it's not really worth it. So what you want is you want the company to continue increasing in revenue, so that that number is greater than 1. Okay, and if it's greater than 1, that means that the shares are undervalued. If it's like 500 as opposed to zero 0.5, then 500 means that those shares are undervalued, and you can probably feel confident about buying that company and uh, making some money later on. So, kind of an analogy is getting something on sale, right? You're going out and you're buying a classic car, or you're buying an antique that you found at the thrift store for $5, that someone really didn't know it was really worth $1,000. Okay, that's undervalued, and the same thing applies. So if I have a 0.20, then it's overvalued. But if I have something above 1, then anything above 1 it means that the stock is worth more than what it's being sold for. Okay, so that's the indicator of EPS. Okay, so let's talk, and this will be the last thing that I talk about. Let's talk about um, how you can use a graph to determine uh, when you buy something. So think of a graph as an indicator to help you know when something is on sale or not. It's not on sale, it is on sale. It's not on sale, it is on sale. I can sell when it's going up or when it's starting to come down. I can buy when it's down here or starting to come back up. Okay, so here's an example up here. I'm coming down. I could probably buy right here or right here. So you're looking at this trend line and you're saying, okay, well, at some point, this thing's going to turn around and come back up based on history, right? So I probably don't want to try and guess the exact point where it changes. What I want to do is say, okay, well, here's my trend line. This is kind of like an average, right? I can pick a percentage below that trend line and say I want to buy at a certain percentage below that trend line. So let's say this trend line right here would be $1,000, right? And right now it's selling for $900, right? At this point right here. Well, that's 10% below the average trend line. Well, so I'm going to pick a percentage. That's going to be my strategy. I can say I'm always going to buy at 10% below the trend line. Okay. But my recommendation is don't buy if it's continuing to go down. So don't buy on the downward. Wait until it actually turns around here and starts going back up like this. And then you can buy at that same 10%, and you can pick a number. It doesn't have to be 10%. You can say 5% or 3%. You can say 20%. You know, it's up to you, but make sure that you try and pick something that is within the, you know, a reasonable amount, um, because you know it's going to be turning back around, and if you wait too long, you could miss out. And also, if you're buying on the right side, after it started going back up, let me use this bigger line right here. If you're buying on this side, you want to buy it before it gets past that average line, okay? But if you're buying on the left side of that downward turn, then you want to buy it at a certain percentage that you chose below that trend line, okay? So let me kind of make it bigger. Let's expand this right here and make a bigger, you know, kind of zoom in like that, right? And here's the trend line right here. I like to buy after it's already come back up, but it's below the trend line. So maybe I'll choose about 10% below this amount right here. Okay. And if this is worth 1,000 right here, then I'm going to buy at 900 right here. If that makes any sense, because that's 10% of 1,000. And the reason I don't like to buy when it's going down is because there's always a chance that it's going to go, you don't know, you don't know where this bottom's going to be. So if you buy over here, it's possible that this thing could keep going down even more. And then this is going to be worth less and less, right? And you're not really losing money, but it's going to take long to recover. So I don't recommend buying on the downward side. I recommend waiting and letting it come around, and then buying somewhere on the way back up close to this trend line. This trend line, if you look out here, over a long period of time or a short period of time, you can kind of have an indication of what the pattern is going to be, right? So I'm going to buy here, okay? Now, if you buy on the way down, then you have to wait for it to come down to its final place, turning point. It's going to be worth less and less and less, and it's going to have to come all the way back up here before you break even, right? And usually things drop faster than they rise, okay? So that's why I kind of I prefer to buy things on the way up, okay? Now keep in mind, I'm still talking about investing in a company that I want to improve. There are ways to make money on a downward trend, but we're not talking about that. Okay, so that's when you buy. Let's talk about when you sell. So let me kind of come over here a little bit, and let's expand on this point right here. Okay, so this point, my trend line's kind of bad, but it'd really be going through here, right? But let's zoom in on this right here. That's this part right here, okay? And let's put my trend line right here, okay? So in this area, somewhere around in this area, I want, hey, that looks like an anarchy sign. I want to sell, right? Now the good thing about this is that because of the trend line, I don't even have to sell anywhere around here, right? I can let it sit for another 5 years. I don't have to sell. But if I'm in the mood to play around, I want to pick a selling point that would have made me a profit from the last time that I bought. And as you recall, I had bought down here below the trend line. Now I'm going to sell somewhere above the trend line here. Okay? So, where am I going to do it at? I would rather sell after it's already turned right here. So on the right side, I want to sell somewhere above this trend line. And maybe I'll choose 10% above this trend line. So what if I bought it over here at 1,000 or 900, I'm sorry. Over here, I bought it at 900. So over here, it's at 2,000, right? And right here, it might be 2,500. Okay. So let's make the numbers easier. Let's call this 1,000 and let's call this 1,500. Okay. So I bought it at 900 on the way up, and then it starts coming back down, and I want to buy it definitely want to buy it before 900, right? But I want to try and stay above that trend line. So the trend line would be at 1,000, and right here, 10% above 1,000 would be 1,100. So maybe I'll sell at 1,100. Okay. Well, now what I've done is I bought at 900, I've sold at 1,100, I've made $200 profit, right? And then that's basically $200 over $900. If you do the math, what is 2 divided by 9? 2 divided by, hey Google, what's 2 divided by 9?
2 divided by 9 is approximately 0.22.
Okay, so it's approximately 0.22. That means that $200 that you made is a 22% gain. If you were able to do that...
I don't know, but I found these
okay,
results
Google,
on search.
Stop. Okay, if you could make a 22% gain once a month, and you add up all those 22% gains over 12 months, hey Google, what's 22% times 12?
22% times 12 is 2.64.
You will have almost tripled your money in 1 year. Okay?
I don't know, but
now,
I found these results
okay,
on
Google,
search.
Stop. So basically, if you can do that once a month or once a day, you can rock. And you can literally become rich. It's not always that easy, though. On paper, it's easy. But if you think about it, if you can maybe get it right half of the time, or a third of the time, or a tenth of the time, you're going to make 1, 2, 3, 4, 5, 6, 7, 8, 9, 10%, 20% gain that year just from playing around by looking at patterns. Okay, so that's a fun thing to do. It's called pattern trading, and it's not a perfect science, but it's a fun one to play. Much more fun than the lottery or the stock market. Next time, we'll see what else we talk about. Thanks.